Amortization is the process of spreading out the repayment of a loan or the cost of an intangible asset over time. It helps borrowers understand how much of their payment goes toward reducing the loan balance versus paying interest, and it helps businesses account for expenses related to intangible assets. Let's break it down with simple terms and an example. When you take out a loan, such as a mortgage or car loan, the lender typically structures your payments so that you pay the same amount every month. This monthly payment is divided into two parts: principal, the amount borrowed, and interest, the cost of borrowing. In the early stages of the loan, a larger portion of your payment goes toward interest, and as time goes on, more of it goes toward the principal. This gradual reduction of the loan balance is called amortization. Here's a simple example. Imagine you borrow $10,000 at a 5% annual interest rate for 5 years. Your lender calculates your monthly payment to be $188.71. In the first month, most of that payment goes toward interest, about $41.67, while only $147.04 goes toward reducing the loan balance. As the loan balance decreases over time, the interest portion gets smaller, and more of your payment applies to the principal. By the end of the loan term, the balance is fully paid off. Lenders often provide an amortization schedule, which is a table showing how each payment is split between interest and principal over the life of the loan. It also shows how much of the loan balance remains after each payment. This schedule helps borrowers see exactly how their loan is being repaid and plan accordingly. Amortization also applies to businesses when dealing with intangible assets like patents, trademarks, or copyrights. Instead of writing off the cost of an intangible asset all at once, businesses spread the expense over its useful life. For example, if a company buys a patent for $50,000 with a 10-year lifespan, it will amortize $5,000 each year as an expense on its financial statements. This process helps match the expense of the asset to the revenue it generates, following accounting principles. Why is amortization important? For borrowers, it provides a clear repayment plan and ensures the loan is paid off by the end of the term. For businesses, it helps accurately reflect the value and expense of intangible assets over time. It also plays a role in tax planning, as both loan interest and amortization expenses may be deductible in some cases. In summary, amortization is the process of gradually paying off a loan or spreading the cost of an intangible asset over time. It ensures consistent payments for borrowers, provides transparency with an amortization schedule, and helps businesses manage expenses in line with accounting rules. Understanding amortization is essential for managing loans or intangible assets effectively.